Okay, welcome back. We're back here and with David Ryan, of course. And we're going to, well, first of all, let's talk about what we just went over. We went over categories and catalysts, and we talked about the various categories that we focus on and the characteristics of those various categories. Now, again, I want to point out that we're just giving perspective here. And this next topic, we're going to talk about valuation. And valuation, really, we're not value buyers. And when you're a growth stock trader, you're going to be by default in stocks that have high PEs and look like they're expensive. That's what we talked about earlier, that the leaders usually look expensive. But when you have a stock that has a really high growth rate, and I'm going to talk about this a lot more when we talk about the fundamentals, but when you have a really high growth rate, it's very hard to put an appropriate valuation on these stocks. And that's why valuation doesn't matter that much when you're dealing with a stock that's growing at, like Cisco Systems, when it was growing very rapidly back in the 90s, they had 16 quarters of triple digit earnings. Now, you can do that math. I mean, even if you're a plumber, or maybe you have a small business and maybe your sales are, I don't know, $500,000 or $600,000 a year of revenue. Take that number and then times it by 100 and do that every 3 months for the next 16 quarters. Okay, so every 3 months you take your revenue, you would take a look at how big your company would be at the end of that. And then you'll see why a stock can make such a big move. So we're going to talk about valuation and how it relates to super performance. And again, if some of these if you're a value buyer, and I can't really talk from a value standpoint because you're certainly not Bill Miller or somebody that's good at value investing. But if you have a very low, growth rate, then, you can put an appropriate PE on there because the company is growing so slow and usually have more visibility. When you're growing at 100%, the visibility is so limited. And same thing on the downside. I mean, if those companies falter, they can have a big problem because there's so much growth that's baked into the price. So let's talk about this. I don't know if Dave, I don't know if you have anything to say to start off here, but
well, I think the most important thing is that the greatest winners of all time, a majority of them. I mean, and maybe I don't know exactly the exact figure, but I mean, I know it's like 75, 80% had. I think the average PE of a super performance stock was twice that of the S&P 500. So if you were going to say, well, I'm only going to buy stocks that have a PE ratio that is the same or less than the S&P 500, you right there might have eliminated all the great winners of, the greatest winners of all time out of your portfolio if you won't pay more than what the S&P is valued at.
Yeah, and that's a good way to start here by taking a look at. We all know this company, right, called Yahoo. Well, back in the 1990s, when I was first buying this, I was buying it in 1997, and I had institutional clients at the time, and I was trying to convince some of them that Yahoo was a stock they should consider, and they said Yahoo. Nobody knew Yahoo. And the real problem is that this stock was trading at 938 times earnings at the time. So that stock went up 8,000% over the next couple of years. And then it was trading at 1,700 times earnings. So again, these stock now just to point out, this was the birth of the internet, or in the beginning stages of a very exciting area, of a super high growth area, and the unfolding of what we know today as one of the greatest technological advances ever. At the time, there was a whole bunch of stocks that were setting up and breaking out of bases and going into new high ground and had these high PEs, and nobody understood why. They couldn't because they really didn't understand the internet too well. And Amazon was another one of them. Amazon was coming out of a base in 1997, and many of these had super astronomical PEs. Now, I don't even look at the PE usually. I mean, I look at it and I know what it is, but it doesn't even come into play with me unless it's a really low PE. So let's just say, the general market is the S&P is at 22 times earnings, and a stock is at 4 times earnings, and it's a very, very low P. That could mean there's something really wrong, or it's some industry, some very strangely valued industry. So that would be suspicious to me. I like to see a PE that's above the market, and there's a premium. Again, it doesn't really matter. Even if it was a little bit below, I'm really not using the PE as any type of criteria that's going to make me buy a stock or not buy a stock, except, like I said, if it's exceptionally low. Dave, how are you looking at the PE? Are you using it
I
at all?
no, I'm rarely ever looking at the PE, and I was going to say, after working for 17 years at William O'Neill and Company, and working with Bill O'Neill, he never said, "Oh, we can't buy this stock because the PE is too high." We would only be concentrating on what were the size of those earnings, those quarterly earnings and those annual earnings. Well, how big were those increases quarter after quarter, and what is the 3 to 5 year growth rate? That's what we really focused on, and it never came up in a discussion about a PE being too high. He might actually look at the length of the move, how many times the stock had been up, and how long it had been going, but he wouldn't be sitting there trying to put a valuation on the stock.
Right. So later on, when we get into sell rules, that's a very good point that David just brought up. When we get into the sell rules, there is one way we're going to look at the PE, but we're not really looking at it as a valuation. We're looking at PE expansion. And if the PE expands by a certain amount, it could be an indication that the stock has come a long way, and let you know that it's late stage. So that's going to be later on, and we will talk about that. But like I said, there's only a couple ways that we look at the PE, but we're not saying, the valuation, and we're looking at it. So if it's trading at 32 times earnings, or it's trading 1.5 times the S&P, or the growth rate versus the PE, we're not looking at that in a vacuum. So now another thing I want to talk about, and that is, if you start looking at stocks as expensive and cheap, you get into a real problem, especially when you're buying a stock because the stock is cheap. The problem is that if that stock rolls over on you and comes in and starts producing a loss, it gets cheaper. So the whole reason why you bought it actually gets more appetizing. So if you loved it, a PE of 20 and the stock was trading at 60, well, I mean, you really got to love it right at 30, right? If it cuts in half, and the PE is even lower, and it's even more of a value, and that's what I call the cheap trap, where you get caught into this. For the reason why you bought it was cheap, so if it goes down, it's even cheaper, and that makes you start buying stocks and averaging down and buying stocks that are losers, or buying stocks that are falling, and that could get you in a lot of trouble, especially when you're investing in high performing growth stocks. And David and I were just talking about this before, prior to coming on here, and there's a rule. Some of you might have heard me talk about the 50-80 rule. And that rule basically states that, and this is from looking at all the leading stocks going back cycle after cycle after cycle, and looking at these big secular leaders and what happens after they top. And what we found was about 50% of them will go down 80%. And about 80% of them will go down about 50%, or at least 50%, and the average decline is over 70%. So when you're in these high flyers, there's a lot of risk. So you got to cut your loss. You got to cut your loss, get out of there, and not start making a case because the stock is cheaper, and the original reason you bought it was cheap, and now it's cheaper, because it could get a heck of a lot cheaper. And we're just taking a look at AIG here. This was, of course, at a time where we had the crisis, and all the bank stocks rolled over and got in big trouble. And a lot of analysts were like, "Oh, it's trading at these historical low 10-year, 20-year low PEs, and trading 52-week lows, and buying these things, and they all just imploded." Some of these stocks, even the ones that survived, that didn't go under, are still 20 years later didn't even get back to break even. We're going to look at a couple of those in just a minute here. So you got to remember, every 20%, 30%, 50% decline starts as a 5%, 8%, or a 10% loss. It starts as what looks like a not so big deal, and if you sit there and you don't address it, it can become a big deal very quickly. And it doesn't matter the quality. And Dave, I would like you to talk about, people think, if you buy a quality company, you buy GE or IBM, we can go back over time and find, the Amazons and the Googles of the day of, say, in the 90s or even in the 80s or the 70s, and you go all the way back, and there was always some companies that you felt like you could, they were bulletproof, right? I mean, right. Yeah, so that's what worries me nowadays, because everybody thinks, Amazon, Google, and maybe the FANG stocks, they can't go down, but they thought the same thing about GE. Look at GE right here. This stock went down 90% and still has never recovered. It's not even back to your purchase price if you were buying it here and you refused to sell it, just back in 08, 09, or prior to this decline.
Yeah, and you, I think you mentioned Cisco. How Cisco had such great earnings, but Cisco topped in the year 2000, and now so many years, decades, now 2 decades later, Cisco still has not surpassed that high. And even though it might be cheap, it has underperformed for 20 years. So just because something is a quality known name and a blue chip and maybe might have a low PE, that's not a reason for you to buy that stock.
Yeah, there's no such thing as a safe stock. They're all stocks are risky, and they can get cheaper and cheaper and cheaper and cheaper. And we've heard people say, well, we see stocks go down. They're down 50% or even down 80 or 90%. I mean, how much lower can they go? The stock's down 90%, right? How much lower can it go? Another 10%? No. From wherever you buy the stock, it could go down 100%. Your risk is always 100%. So just looking at the example here of Crocs, stock comes off the first 50%. All right, you buy it there. Okay, comes off another 50%. Someone else buys it there, comes off another 50%, another 50%, just keeps cutting it. It could be 90%. This number could be any number from 0 to 100%. Your risk is always 100%. So don't think just because the stock has gone down, precipitously, or if it's down 80 or 90%, how much lower can it go? 100%. 100%. That's how much lower it can go. Now, what we really want to show you, okay, and this is the really important thing. What you'll generally see with strong companies that are in their growth phase, you'll find that when the stocks are doing well, the PE is actually the highest, or it could even start at the highest and maybe even the PE will come down as the stock advances. And then when the stock tops and it's much higher, and now it rolls over and starts getting, quote unquote, looking cheap, the PE gets to the lowest just before it's going to make a big decline, which is the exact opposite of what most people would think. You would think it's very cheap before it makes a big move, and then it would be very expensive when it tops, right? It doesn't work that way. Here's an example looking at Crocs. You can see that before it makes a 400% advance, the PE is up around, 60 times earnings, right? It's the highest that the PE was since the stock went public. Right here, stock starts rolling over, and just before it comes off 90%, a 90% decline in only maybe a year, the PE is at the lowest before the decline. So it's the cheapest before it's going to make a 90% decline. It's the most expensive before it's going to make a 400% advance. This is completely counterintuitive to what most people would think. Yeah. Now, go ahead. I'm sorry.
On that Crocs example, when that stock came off of from 75 down to, I guess, 45 in 1 week, that was actually on an earnings report. And the earnings report was really, really good. But it wasn't as good as people expected. and growth was going to start slowing down. And that's why that stock took a hit. I was in that stock. I sold that stock, or I sold most of it, but I was still in it on that first day down. And then I just sold the rest. But I was out, I think, probably above 60. And then by the end of the week, it was all the way down at 45. But the key is always keep those losses small, and you don't want to compound a losing trade by adding to it. That's the first rule I've always used, is never add to a stock that you're losing on, and because you can see what can happen.
And the reason why we're telling you this now with this valuation section is because you can start rationalizing and coming up with, the stock's cheap, and you might even hear this. Maybe a broker tells you, or you see it on the TV, and somebody talks about how the stock is cheap. This is where you can really get caught into that cheap trap, and you got to be real careful. You want to buy. It doesn't matter if you're buying expensive stocks, as long as they get more expensive, right? So again, let me show you another example here. This is one that David and I both bought. We literally bought this to the same day. I actually bought it, and I added to a little bit more. I traded it a few times through this move, and Dave actually held it through a good majority of this big move that it made. This is Ollie's, and this is where both of us were buying coming out of this base here, this primary base, as the stock was making a new high. It was a recent IPO. You can see that the PE is way up here, around 145, 150 times earnings. Even when we're buying it, it's in the neighborhood of 100 times earnings. So, that's obviously that's no value stock, right? But here's the interesting part. Look at how it makes this big move. The stock goes up over 300% in 30 months. And look at the PE. The PE after that big move is half. It's half of what it was prior to the move. Now, why is that? Why would the stock go up so much? It goes up 300%, but the PE is cut in half. Shouldn't that be getting, Dave, shouldn't that be getting more expensive?
No, because the earnings are so strong. The earnings are running faster than the stock price is, and so that's why the PE ratio is coming down.
And that's where a stock is priced pretty much at where it should be at any given time. And when you've got that big growth rate, you really can't bake that into the cake, because it's just, no one knows how long a stock, I mean, for the stock to go up 300% and the PE to be cut in half, that means that the growth of the company had to grow at a much faster rate than that. So no one knows, not even the CEO knows how long that's gonna last. And that's why these stocks can just keep going and going and going. And the PE will either sometimes get even cheaper or lower, because the stock price is not outpacing the growth of the earnings. Now, in some cases, I'm going to show you another example here. We look at Taser. So I bought Taser. This is one of the stocks that I bought after taking a pretty long sabbatical, after I got out of the market, and we topped in 2000. And I called for that big bear market. And this was a time where I was going on TV back in the 90s and into 2000, 2001, and talking about basically I was basing my call on these stocks, these leaders that have topped, on the 50-80 rule. I said that these stocks, like the Microsofts and the Qualcomms, the EMC, and all those names that were the high flyers, basically the FANG stocks of that era. I said these are going to go down between 50 and 80%, and some of them are going to go to zero. And that's exactly what happened. The average stock of those big leaders was down about 86%. It was just an incredible bear market. So I moved to the sidelines and was sitting in cash for quite a while. And then when I came back, one of the stocks that I bought, that was one of the first names that I started buying, was Taser. And I'm not going to get into the story behind this, but it was the stock had already had a lot of news and things were going really well. And you can see here, it went up 12-fold in 7 months, and it was trading at 230 times earnings. And I was buying it right here. All right. And that looks pretty high, right? I mean, that looks not only expensive, but just look at this move that it made, this giant move, right? So I did not worry about how high it went because I had my plan, I had my stop loss, I knew how much I was going to risk, and it met all my criteria. This was coming out of a very powerful situation. Now, watch this. If we take a look at it and we look at it from where it went, I'm buying it right here at about, like I said, 230 times earnings. Does it look cheap now, 23 weeks later? Stock went up almost 500% in the subsequent 23 weeks. Now, here's the thing to take a look at here too. As it's moving higher and it's coming out of a base here even much higher, I guess maybe up 60, 70% from where I purchased it. Look, the PE is lower now. See, it's actually lower. Then what happens at the end is the stock really starts to accelerate. You see now the PE comes up because the stock is actually starting to outpace the earnings now. So now the stock is growing faster than the earnings. And that's where you can start getting into some trouble if you really start outpacing those earnings too much and the PE really expands. So again, if I were to look at this and use any kind of valuation metrics at the time, I wouldn't have touched this stock. I wouldn't have gone near it. But it was actually quite cheap.
And then one other thing that you should also mention too is that analysts, you might think that the analysts are so sharp and on Wall Street and they know everything about a company, but even analysts are very far off on what they think is going to be coming the next quarter or 2 quarters or the next year, because even they can't figure out how fast this company is growing, and they get it wrong a lot of times. So you can't rely on Wall Street estimates, especially in a super growth stock.
Right. And there's a very good reason why analysts also get it wrong. It's not just that they're not smart enough, but there's another reason. We're going to talk about it later when we talk about fundamentals, where analysts they don't go too far from the herd because it's basically they're protecting their job. So we're going to talk about that too. That's a great point Dave's bringing up, but we're going to go into detail about that. Let me show you Apollo Group here, and again, take a look here. This is really interesting on how this stock, through a time where the market did nothing. It was after you had the big bear market, and the market still took years before it bottomed. This stock went up a couple 100%, 200% in a couple of years. Now, if you look at the earnings, these are annual earnings. You had where the stock in 2003 up 40%, in 2004 45%, and then up 55% in 2005. So this stock basically started at a 60 PE, and after this 200% move, it's still at a 60 PE. So again, why is that? Well, if you compound, and of course it doesn't always work exactly like this, but you can see here how the stock is basically just the same valuation. If you take the earnings and you were to take these earnings and you compound this 40 to 45 to 55, guess what? The earnings are 200% higher. So the stock, even though it's 200% higher, it's valued the exact same as it was 200% lower. You see, market's unchanged, PE is unchanged, stock's up 200%. Why? Because the earnings grew at 200%. So now, here's the thing you really want to avoid. This is where I find a lot of people get in a lot of trouble. They for years through the bull market, or many months, they see, or in some cases, in the case of a secular leader, it could be literally a decade or more. They get so conditioned to a company that has just correction after correction after correction has come back, and it always seems to come back. And after a while, it's that official growth stock, that official quality company. We talked about this earlier, and Amazon would be a perfect example. Google would be a perfect example, where people think, these stocks are just bulletproof. They're never going to, that stock's never going to be down 90% or go out of business. I mean, I heard for years and for decades, I heard it's Coca-Cola. I mean, they're certainly not going to go out of business. Well, maybe not, but the stock could easily go down 60, 70, 80% and stay down for the next 20 or 30 years. So that would be almost as bad. I mean, if you had your money in a stock and it went down 80% and stayed down and didn't come and ever came back for a couple decades, well, that would be pretty much as this, the stock went almost to zero, and your money would be tied up. So what we call this is the broken leader, the broken leader syndrome, if you will. And this is something that I see over and over and over. So Amazon now, corrects and tops and is down 50-60%, right? And the PE comes in and it looks like a value, and you've probably seen it so many times, bounce back. And now you think, wow, this is that golden opportunity for me to buy Amazon cheap. Of course, the people who do this weren't smart enough, to buy Amazon the 15 other times where it set up and broke out, went to new high ground, pulled back, formed a base, and they watched it for a decade. And now all of a sudden, because it's down huge, and because they can pick up the newspaper or look online and see that the PE is cheap and the stock is down, all of a sudden you're a genius, and you're gonna make a bunch of money doing something that the whole world can see. This is usually when it's the end of the move, and this is what you want to avoid. And here's what happens. This is how it usually plays out. The stock has a big break, and it's down huge, and it looks like you're getting a bargain, and the PE will usually justify that. The PE will come down, and the analyst will be saying, this is a value, it's trading at a 10-year low PE, and you're getting it very cheap, and the earnings might even still be growing. So now you get growth at a reasonable price. But what happens is the stock discounts, and the bad earnings haven't come in yet, but they're about to. And then when they finally come in and the losses start coming in, or the real negative earnings, all of a sudden the PE shoots up. See the PE here? Boom, it comes way up, and it's at an all-time high, just like that, because now the bad earnings are coming in, and it all makes sense. And then you get even a bigger decline. That's where the stock underperforms, because a real business change, or some change in the economy has taken place that is really a really fundamental flaw now. Here's lumber liquidators. Perfect example. This was not a secular leader like something like Amazon it has been, or maybe back in the day something like like we just pointed out, this one here, of course. What was Java? What was Java? That wasn't JAVA. Do you remember? I'm trying to remember.
Yeah, it was a coffee.
What was this? Oh, okay. I thought this was a different stock at first. But some of these high flyers, like I said, Qualcomm's a perfect example. Everybody bought Qualcomm all the way down, and even stocks like Dell Computer and a lot of names that you would think today are household names. Cisco, we talked about. Microsoft for decades didn't get back to break even. I mean, this is a high quality company. Lumber Liquidators was not a secular leader, but it was a market leader that made a really big move in a short period of time. And you can see, again, going into new high ground here, look, it's the most expensive, right? It breaks, and it has a huge decline from 120 all the way down to 50 something dollars. And now it's hitting its lowest. It's at the lowest PE. And stock actually rallies a little bit, then rolls over, and then look, see, now you're much more expensive. The stock is now down 90%, but you're way more expensive. Instead of a PE down around, it was even down into like, I don't know, 15 PE here or something, 10 or 15 PE. Now it zooms all the way up. It's over 100 times earnings. See, now it truly is expensive because the losses came in, all the bad news start coming in, but the stock discounted it. Hey, Dave, why don't you talk about also how, what we've learned over the years and over decades is that you usually have the earnings on the table on the upside, and it could last for some time, but we don't usually sell on fundamentals. We usually sell on technicals, right?
Yeah, I've always said I buy on fundamentals and technicals, and I'm selling on the technicals, and I'm not looking at valuations. And after a stock has had when I've seen a stock have a huge run and it's been a market leader, and it comes off more than 50%, I usually put that in the back of my mind that stock is finished, because to get back to old highs, the stock has to double. So this is just, one rule, even without looking at what the valuation is, I just usually just put the stock, into the penalty box and rarely look at it after a big move and after it's come off like that. Because usually when a stock has a 50% drop, it's not going to come back that quickly because it has lots of overhead supply.
Yeah. And why do we sell on technicals and we buy sometimes with technicals and fundamentals, but on the downside or on the sell side, we're mainly relying on technicals. And there's a saying that you take the stairs up and the elevator down, right? Well,
right. And yeah, and I've seen so many stocks have huge downsides even before the fundamentals are announced. I've saw it on Gap stores was down 50% before they came out and said, oh yeah, by the way, the quarter's not going to be good. And so there are people inside, maybe there's analysts that know, maybe there's suppliers that know, hey, things are starting to slow down, and they start selling. And I put a lot more emphasis on supply and demand, on the volume and the price action than I do analyst estimates and how cheap a stock could get on a valuation basis.
Right. What we found is that, the stocks will, when they top, these stocks will discount. They will discount the earnings, and the earnings will still look good. Very often you'll have the earnings where even though they may be decelerating a bit, they'll still be strong. The analysts will still be, having rosy, glowing reports, and the news will generally be good. And the stock will come off, and that's why it'll look like a bargain, because everybody's saying, it's great. Everything's going good. They're still growing. You've got great growth rates. And then the disappointment comes later on. There's an intelligence in the market. It's really incredible how it discounts the future. And this is something that, again, you'll see time and time again. If you go and you look at these stocks, and we're going to show you lots of examples. So let me finish up here. This is just a real quick, perspective that we're giving you. We're going to go through examples. Remember, I started off, I said, we're going to start at a satellite view, then we're going to come down to an aerial view, then we're going to go to an overhead view, and then we're going to get under the microscope and look at things microscopically. So we're still in that satellite view. We're still looking at just a big overall picture, like from space, and looking at putting everything into perspective. So you need all this, though. This may sound maybe like it's basic or remedial, or this is something that will give me I want the buy points, the trade, how do I make the trades, and where do you cut your loss? We're going to get to all that. We're going to talk about everything in absolute detail, but you really need this perspective. It's all this whole workshop is set up in a chronological way. It's very logical, and everything builds on the next thing. Now, here's another thing is very important that you have to understand. Everything that we tell you, every single step that we tell you, anything going forward does not negate anything that we said prior. Okay, so everything builds on the previous. So if we're telling you to do X, well, and then we tell you to do Y and Z, well, Y and Z can only occur if X happens. Z can only happen if X and Y happens. So these are all things that we're going to be building, all right? And you're going to be stacking probabilities and learning how to put all the probabilities and put all the wind in your sail. Get as much information on the right information. That's the main thing, is to get we look at the right things and know what to look at and how to decipher it, and then have all those probabilities in your favor when you're placing these trades, and of course getting out of them when the probabilities turn against you.
Yeah. And I would add that if you've been in the markets for a while and you haven't had a whole lot of success, there's probably a lot of bad habits and a lot of ideas that you have in terms of how markets work and how stocks act that are wrong. And you're going to have to kind of flush your mind of all that and start concentrating on the things that we're going to be going over, because this is what actually works in the marketplace. So yes. There's a lot of fallacies, a lot of almost sayings on Wall Street that aren't really that true. So you really have to have an open mind for all this that we're going to be pouring out at you.
Yes, and that pouring is a good word, because what I like to say is that you have to empty your cup. You know, if you want us to fill your cup, it has to be empty. We can't, if you pour a liquid into a full cup, it overflows. It can't go in there, right? So this is part of emptying your cup, right? We're gonna try to break some of the preconceived notions and the myths and some of the things that you might think, you know, are important, and try to narrow you down to really getting to really what works and really what is important. Well, even more important than knowing what works is to being able to just ignore everything else. And that's what I find, that even when I show and teach people what to do, they still try to bring in all this other stuff. You know, they'll say, well, I'll do that, but I'll add in the stochastics indicator and only buy when it's at this. And, you know, I'm going to blend it, and I'm going to take Minervini's work, but I'm only going to buy stocks that are value, you know, a certain value. I'm not going to buy the real expensive stocks and just put it into, it doesn't work that way. All right. Like I said, everything builds on the next, and this is a full program. All right. We're going to give you everything A to Z. You're not going to need to make any changes. You're just going to, and believe me, you don't want to, because it's going to take you a long time to perfect this in itself.
Yeah, and I think what really helps is when they get their first big winner, when they actually buy a stock correctly at the right buy point, and that thing takes off. Pretty soon you're gonna start saying, "Man, this I've never seen this before," and you're just gonna want to do it over and over again. So, but it takes time. It takes time to throw out all the bad habits and bring in good ones. So it can be very, very rewarding.
So I'm going to finish up with one last point here. And as we're saying, we talk a lot about big winning stocks, and we're going to show a lot of big winning stocks, but that doesn't mean that we don't do a lot. We don't do short-term trading too, or swing trading. And so what I'm going to show you going forward, the buy points are going to be exactly the same, whether you're swing trading or you're going to hold it for a much bigger move. The only difference is that you'll probably apply it. I'm going to show you how there's different areas where you're going to apply it a little bit differently. And I don't mean differently in the respect of different rules for buying, but so you're in the beginning stages of a bull market. You had a bear market, and you come off the bear market lows, maybe your first rally off the lows, bunch of stocks set up, they're breaking out of bases. You might be on to a big secular winner that's now about to be the leader in the next bull market. You're not going to want to trade out of that whole position and just, you know, do a quick trade on that. You want to hold some of that and try to play it for a bigger move. Now, on the flip side, let's say you're in a bull market and years go on, and everything's been coming out of base after base, and it's very extended, it's getting volatile, and you're not getting big moves out of stocks. You're going to buy from the exact same buy point, but instead you might be selling and taking much quicker profits, and adjusting your losses in relation. So everything is going to be exactly the same. If you're thinking, oh, I don't want to, I'm a trader, I don't, this long-term stuff. No, it's all the same. You're going to be, whether you're going to be trading out and swing trading, or you're going to be holding for a bigger move, we're going to be buying from the exact same buy points. And there's been times, like for instance, I showed you Yahoo went up 8,000%. I did not hold it for an 8,000% move, but I had a double on it. Then I was up about 60% another trade. I was up 30% another trade. And I traded that stock 15 or 20 times during that move, and compounded. I made a huge percentage. So again, everything's going to be the same, but we're going to go through this in absolute, incredible, nauseating detail. But we got to give you this perspective, and we have one more. We're going to come back and we're going to talk about one more area that's going to give you that broader perspective, and then we'll start getting a little more focused. We're getting into the earnings and sales and profit margin, the fundamentals, and then we get into the really fun stuff, the charting, and really get down to the buy points and risk management, position management, and all that great stuff. All right, so we're going to take another break, and then we'll be back.